So, firstly, I am Harsh, first year BSMS, and I will be presenting the slides till Anshuman reaches here. So, before starting the session on fundamental analysis, I would like to announce equity research competition conducted by Artha. The dates will be announced soon. So, upon hearing the announcement, you might feel like, what is an equity research competition? What is equity research? We'll discuss upon that till before the class starts. Firstly, what is an equity research? Does any one of you knows what is equity research? So equity research, the competition will involve 3 steps for you to do. And before you join the competition, Artha will conduct sessions for how will you do the equity research and how will you find materials, and Artha will watch over your progress. Equity research is just finding the balance sheets and data sheets and mostly chartered accountancy for the companies, seeing their profits and loss over a time and commenting upon how the company will do in the future. And once your research is completed, you will have to write a report upon the company, whichever company is assigned to your group. I think you can make teams, but not more than 2. But you can go solo also. And regarding the report, how will the competition be proceeded? Artha will conduct 2 sessions, excluding this one. This will also cover on some fundamentals, fundamental analysis, as the title suggests. Have any one of you attended the previous technical analysis sessions? So we'll also touch up upon that also in the session, so you can get invested. So the competition will be conducted in 3 stages. Firstly, Artha will conduct 2 sessions upon how to research, how to find the balance sheets of companies, and how to judge upon those datas by seeing them. And then Artha will give you time, 1 week or 2 weeks, for which you will be given a company or a group of companies for which you have to conduct sessions and write an ER, equity report. And then the top teams will be selected and be judged by some higher judges, and 1 or 2 teams may get the winning prize. The top teams selected must pitch their ideas to the judges, the higher judges, and they will finally judge upon whether you made a good research report or not. So, a good equity report consists of these 5 values. First, you can check the company overview. I have provided an example just after this slide so that you can check if you have written a good report or not. You will be given a company, so the first step is trivial for you. But second step, fundamental analysis, for which you must attend our sessions, without which you might not or may not be able to do it. Evaluation matrices, for which you will have to dig up the information from Google, ChatGPT, or read some papers and financial letters. Then analyze past 1 year, 6 months, or 3 months of market trends to see how well the company is doing. Is the stock overvalued or undervalued, or it's just sitting there. And then your reports most main part is the investment and fundamental risk, upon which, like, the company you have given, let's say Tata Motors, you will comment that is the stock worth buying, or what are the risks involved. An equity report can be like summarized in 2 pages, but most companies stretch it to 42 or 100 pages. You can write 1 or 2 pages, or you can just speak about it, but writing will be recommended. So here's an example of an equity report. It is just like the heading on first page. The whole report is 42 pages long. I haven't included that much. As you can see, there is a company overview. Then there are matrices written. The financial analysis part is skipped there. You can see here just matrices are like the matrix, how well the company did in last quarters has been written. And then market trends you have to analyze for yourself. You can write that in your report, but you should just consider that in the investment and risk section. And finally, the last section is not written here because it's just the heading. Now we are starting the session today. Today the announcement is done. When the competition will be conducted, the Google form for registration will be sent to you on your emails. So an overview of contents being covered today is like part 1, financial statements, financial ratios, evaluations, only the qualitative aspect, because the quantitative aspect was discussed in the technical analysis sessions if you have attended. And the second is equity research guide through, as the 2 sessions which will be conducted for the competition. This session will work as in preamble or prologue for that. So attending this will ensure that you do well in the competition. So how will you research for an ERC? First, there are 2 types of analysis you can do on a market: fundamental analysis and technical analysis. Which one is more suited for an ERC? Of course, fundamental analysis, because we are discussing that today. Fundamental analysis versus technical analysis. The main focus of fundamental analysis is that it's more long term. As the name suggests, it's more about the fundamentals of the company. In this type of analysis, you try to find a company which for which you think the stock is undervalued or overvalued, and write that in your report. While technical analysis is more of a short-term thing. Traders do that. Intraday traders. Suppose you are investing for 1 or 2 days or 1 or 2 months, then you may choose the technical analysis options, because for technical analysis you will look at the market trends more. You also look at the market trends for fundamental analysis, but that's the only thing you look at for technical analysis. You will look at how the company performs and do some mathematics on that and predict will the graph go up or down in the future. While for fundamental analysis, you will go for more fundamentals, like how the company's work culture affects it, how is the company's image in the market, how well has it done in the past. Remember, past performance also judged in the technical analysis section, but usually 1 or 2 months. In the fundamental analysis, you try to play the more long-term game, like for 1 year, 2 year. So it's like a safe investment option. It's that one's for traders, this one's for investors. Any question regarding the competition, or shall I proceed ahead? No. So regarding these sessions, those sessions will be conducted not by me, but someone who explains a far lot better than me. In fundamental analysis, you try to judge the fair, you know what a free market is, right? A free market is in which you can't make money, technically. So you try to judge the fair value of the share you are buying. So, like, there are two types of analysis here: bottoms up and top down analysis. You can see one of them, this one, top down analysis, is fundamental analysis, and one of them is technical. So if we see the chart here, if a company's face value, not the market value, is going downhill, like you can say it's being cancelled on Twitter, which one of these will be affected? Yes, but let's say technical will be affected because it looks at the more short-term gains and does not really look upon the future. Remember, the goal here is to like see which one of these will better help our investments grow. They both are really good in their own games. If you like use fundamental analysis for short-term gains, you are more likely to not succeed than you are, and vice versa. In fundamental analysis, there's one key thing that most people overlook, and that's the work environment in the company. Like, see, if there's a company which is like firing a lot of people, and let's say Amazon, Amazon fires 1/3 of its workforce every year. Like the bottom workforce which don't meet their expectations. So, that's the norm they have like clearly stated, but there are also other companies where the work environment is also really toxic. Which one of these will be affected more by that? Fundamental analysis. You can see, if you are focusing on an industry specific theme, like suppose automobiles or Silicon Valley or anything like social media companies, you are doing top down analysis. You are choosing a sector and then focusing on a company later. In some other ways, like you are first focusing on, like in the IT sector also, let's say Google, you first check their scores and then compare them with the rest of the company, like rest of the things. Like actually Google is like a subsidiary of Alphabet, so you share Alphabet and then compare it with like Facebook and other tech giants like Amazon, Microsoft. Then you are doing bottom-up analysis. So fundamental analysis is really quality specific and not quantitative data like financial statements, financial issues, the cash flow, which is really explained by the balance sheets and the statements which company releases in like quarterly, annually or bi-yearly. Well, today's focus is more about explaining the qualitative data, which is again company's fundamental business model, who are the company's clients or users, competitors or major shareholders, and future vision of the company. Like let's say a company is doing really well today and the company has no plans for the future and the market is really dying. A good example of this will be Nokia, which was doing really well before, even at the time iPhone was launched. But the company saw that and didn't do anything, and then in the upcoming years it got crushed and now we don't see their phones anymore. But at that time also you can just search technical analysis. They were saying that Nokia will skyrocket, the iPhones won't do much. But that time, if you were the iPhones were launched in 2007, and if you see 2008 reports about the company, you can see that their fundamental analysis reports said that the company share will skyrocket, and as they did, we all know. So, finding a company for your equity research, you can try these two approaches. Top-down approach, which is like first you choose a company, then find its sector, the areas in which the company is like planning to expand its business. Like Google acquired Boston Dynamics because it was really trying to go in that AI market. And then filter out the companies which you think will progress or like go uphill, the stock prices will rise in that sector. And then select a good company to invest in. But like you can also use the bottom-up approach, which is, by the name suggests, really opposite to the top-down approach, in which you can use, like, in which you don't see graphs at all. or like at really late, and you just see that a company with strong fundamentals, which has been working really well, has future plans to expand, is what, like a good example of this will be Google, because the work culture there is good. The company really wants to expand, but like, actually the better example will be Microsoft, because it in recent years expanded its business into AI and bought ChatGPT, which is quite near to overtaking Google as a search engine. Most of the people nowadays don't Google search, they search ChatGPT on Google and then search their questions there. And upon choosing a company, like let's say you chose a company, any XYZ motor company, you did your fundamental analysis on that company and found out that the company has a good work culture, is really planning for the future, and like the data sheets are indicating high profit for the last couple of years. Then we will carry out a sector specific analysis, which is like the automobile company and its rivals, and you try to find out where does that company stand in competition to its own rivals. Let's say the company A, you did your research on company A, and you found out that it is not really lacking in the fundamental department. Then you go to the other companies, check out the other companies, do fundamental analysis on them, and in that sector specifically, and check if the company is really doing that well as it is supposed to do in that sector, and if not, you should find out the reasons and write that in your report.
So बॉटम अप ज़्यादा बेटर है बिकॉज उसमें हम स्पेसिफिक कंपनी से शुरुआत करते हैं, फिर हम आगे की तरफ जाते हैं. टॉप डाउन में क्या होता है कि सुनने में बहुत अच्छी लगती है, बट उसमें इतनी एनालिसिस करनी पड़ती है, दिमाग ख़राब हो जाता है बेसिकली. क्योंकि उसमें पहले तुम इकोनॉमी देखोगे, इकोनॉमी के बाद फिर सेक्टर देखोगे, इंडस्ट्री देखोगे, इंडस्ट्री ट्रेंड्स देखोगे, फिर आकर कुछ 2-4 कंपनीज पर आओगे, फिर एक कंपनी पर आओगे. बहुत टाइम कंज्यूमिंग होता है, इसलिए जो बॉटम अप अप्रोच ज़्यादा बेटर होती है. उसमें थोड़ा कम काम करना होता है, कन्फ्यूजन कम होता है बेसिकली. So we will look at an example for pharma industry, and the company we gonna study is Cipla. Cipla, as you know, it makes cheap generic medicines. Generic medicines are basically the medicines for which the patent has expired and now anyone can make it without any royalty and something. So generic medicines are cheaper as compared to branded medicines, and that's why even government also promotes generic medicine, because the composition of both the medicines are the same. The point is just that generic are much cheaper because they do not have to bear the research and development cost involved. And Cipla is a pioneer in that. It exports these generic medicines in countries like Africa, even US also, at a very cheap and affordable prices. So although if you do a top-down analysis, the analysis starts with GDP actually. But in the case of our case study, GDP analysis is not important because the thing is pharma. These are generic essential medicines and they are not impacted by GDP. And even in cases like if some COVID type event is there, the GDP will fall, but this company will do even better because of the demand of medicine will even increase. So a direct correlation with GDP, not even country GDP, not even global GDP is not there. So, but you can study about what are the trends in the industry, how trade is being impacted, what are the FDA licenses there, in which countries Cipla's medicines are being supplied. But if it is a case that we are studying some other business, like for example, we are studying doing fundamental analysis of maybe let's say Apple. In that case, starting from the top will be important because you will buy Apple products with your disposable income, and disposable income will be only there if unemployment is low, if people are getting higher wages. This will be only possible in an environment where interest rates are less and GDP growth is high. So in that kind of industry, doing a top-down analysis is much important, because all this GDP data and industry data impacts a lot, but it's not in the case of farming. So for example, increase in GDP leads to increased employment in the pharma industry, because there will be more money to spend for the employees. So this will lead to increase in per capita income, because although the impact will be very less, and because the per capita income of people is increasing because of higher GDP, they can afford better healthcare. And this will in turn indirectly, it's not a direct correlation, but an indirect correlation, that this will boost the pharma industry. In the case of, if negative GDP is there, so per capita income will decrease, so people will not be able to afford better healthcare solutions. The second thing is inflation. So inflation is basically the cost of things going up. So for example, the cost of essential things goes up, so what happens? Disposable income of people decreases. Like for example, if you are paying more for basic grocery and stuff, so your disposable income will decrease. That will lead to less discretionary spending, and that will indirectly impact GDP more. So it's a kind of a loop, if you see. So if more inflation is there, it will have detrimental effect on pharma industry. If unemployment is increased, again negative impact on pharma industry, because also pharma industry is also very much impacted by insurance, because insurance, it's not very prevalent in India, but in advanced countries like US, what happens, most of the healthcare cost is covered in insurance. So insurance companies pays for healthcare. So if unemployment increases, so for example, a person loses his job, so he will not be able to afford premiums, insurance premiums. So what will happen in turn? It will be detrimental for pharma industry. This is the example how you do a top-down analysis when you start with GDP and employment data and all. Also, in our case, government initiative also help, because there are a lot of schemes by government. For example, Pradhan Mantri Ayushman Yojana is there. Okay, Jan Aushadhi Kendras being opened. There is a Pharma Vision 2020, or now 2030 vision are also there. There is PLI schemes by government, in which government is incentivizing Make in India medicines by giving them production-linked incentives in the form of cash benefits, cheaper electricity, maybe also rebates and taxes and all. Also there are things like during COVID-19 giving free vaccines by government. This also impacts the revenues of these pharma companies. So we will look at all these data, also coupled with what are the recent government initiatives are being taken. Is there some policy? For example, there is a policy about, which is written in the BJP manifesto of 2024, which is regarding your API. So API are active pharmaceutical ingredient. These are the salts through which formulations of medicines are made. So currently what happens, most API manufacturing is done in China. India has API manufacturing, but it is less. So think of it as a raw material for making medicines. So government will be, in this scheme, government will be giving incentives to the API companies. For example, the biggest API company is Divi's Lab. So automatically Divi's Lab will get more benefit, right? This is also looking at government initiatives. One more example can be a government recent push in infrastructure sector. So for example, in 2021, 2022, 2023 budget, what happened? There was an increase in government spending in infrastructure, especially railways, defense, and these sectors. So what happened? All the stocks rallied, because what was the expectation of people was there, that because of these increased spending, there will be more spending by government. That means that these companies will have more order values. So that's why the share of all railway stocks, maybe RVNL, IRFC, stocks of defense stocks like Cochin Shipyard, like HAL, all these stocks like boom because of increased defense and infrastructure spending by government. Also, global factors. For example, if Trump comes to power, he will most probably announce a trade war with China, in which they will impose tariffs on Chinese products. What in this in turn does it? it makes these Chinese products less competitive in the US markets. So for example, in this case, maybe if these type of tariffs are not imposed on Indian companies competitiveness in the US market increases, so their sales might boost. So thus, such kind of analysis is also important. Like one more example can be due to if Trump comes to power, he will impose do a trade war. Let's suppose with China, he imposes these 100% tariffs on products. Then what will happen? The inflation in US will increase. Why inflation in US will increase? There's a very important statement which is said that China exports deflation to the world. Why? Because China exports these low-cost items. So this is actually the reverse of inflation. For example, you might be getting American phone, Apple phone for $1,000. There's a Chinese company who is selling the same phone with same specification maybe for $200. So this is in fact is deflation. So this case will increase inflation, and the inflation will lead to different outcomes on different companies. So this is the level of analysis you have to do. Like technology. So for example, some new technology comes. For example, this company we are talking about, let's say Cipla, they are doing some research and development on maybe some drug on cancer, and they found a drug for cancer. So if they are able to find a drug for cancer, you will see the share price of these companies will increase like anything, because now the market will think like if they can make this drug, most probably they will able to commercialize it, and then the sales and profits will increase. The same example happened for some company in India called as Glaxo. So what happened with Glaxo? They found out they did some R&D and found some drug. I'm forgetting it in 2016 something around, and at that time the stock price is down. The same thing happened with the company that made COVID vaccine. Which was the company which made COVID vaccines? US company is it? AstraZeneca. After it has announced the COVID vaccine, the share prices like increase very heavily. We can also see in charts due to that. So if there's some technological innovation happens, some research and development innovation happens, especially in the case of pharma and technology companies, their share price will increase because of the expectation that market has. Like, so we will start with global trends. Like, so first global trend is the CAGR of pharma. So pharma will never have a very high growth rate, because you will not have people falling ill by 30% and more than 30% every year. That's not going to happen. So they will have some normalized kinds of growth. For example, in this case, it is 9% CAGR. CAGR means compounded annual growth rate. Every year, how much growth is there in the industry. So this is the total industry size. You can see the global pharma is around $1454 billion, means around $1.5 trillion to $1.6 trillion in 2022. Also, in case of pharma, there is one more factor, that is aging population. So even though the population is not increasing at the rate of 9%, why this 9% growth is there? Because aging population is, demographics is shifting more towards elderly, and because they require more healthcare, so healthcare expenses increase. That's why this 9% growth is even coming. For India, this growth will be even higher, because earlier there used to be section of society which was left without modern healthcare. They were left with maybe Quarks or maybe Ayurveda or something. But now they are getting good, proper, modern healthcare. So because new people are coming in the market, that's why in India, if you see this growth rate will be more. Then this is a very famous MBA framework, SWOT analysis, which is strength, weakness, opportunity and threats. So for example, in this case, the strength is there is a broad customer base. From every income section will require healthcare, will require drugs, which Cipla is selling. The second thing is skilled staff is the strength of this company. It has very good manpower. And if you see the return on capital and return on equity of this company, it is also good. I will show look at this in screen. The weakness is because of less salary, low staff model is there. There is lengthy decision making process. So this kind of things are their weakness. So this is just an example. For any company you are doing analysis, for example, you are doing analysis for Britannia. For example, you can do analysis for Tesla. For any company you do, you can make this matrix sort of a thing and do a SWOT analysis. Like, so this is opportunities. Like the market is growing, there is increased government support, as we see in the case of Pradhan Mantri Jan Aushadhi Yojana and these kind of schemes. Then there is the more patents they are filing, and there can be threats. Threats in the case of if, so for example, government increase regulation. If they are doing some sort of R&D and the R&D doesn't pay off, they got failed in R&D, so their R&D cost can increase. So that can be a threat. A declining economy can be a threat, or a demographics which is getting improved, like improved in the sense that so the current trend is that more elderly are getting in the population. If the reverse happening, if something happens that young people are increasing the population, that will be detrimental for this company because young people require less healthcare cost. So first you will study about the company, that what the company does. It develops these medicines. Where does it spend its money? So it spends its money in research and development. So for example here, the company spent around in FY21 932 crores, which is around 6% of its revenue. So you will do such kind of analysis, then you will say that what is the current market share of Cipla. So for example, market share in the sense that where exactly Cipla is selling its medicine. So for example, in India it is 40%. The second biggest market is North America here, which is 21%. So market share mapping is very important because, for example, something happens. For example, Israel-Iran war happens. Then you will think of how much percentage of revenue of this company coming from this area. So for example, you come across 5% of it coming. So you will not panic much as compared to maybe something happening with US economy. Maybe US economy goes into recession due to something. Then you will worry more because US contribution is 20% to the market. So this kind of analysis is very important. The third thing that you see, the most important thing, is the management, because a bad management in a good business makes the business bad. A good management, a very competent management, even in a bad business, does wonders. For example, let's say, take example of, let's take first example, bad management, bad business. Vijay Mallya, bad management. Airlines he did, bad business, did blunders. Bad management in a okay business. Vijay Mallya again, but in his second business, which is Global Spirits, which is an alcohol brand, Kingfisher, beer and all. So it's a good business. Beer business is a good business. But good business coupled with a bad management, the company struggles. Then come to again third scenario. Very good management, bad business. For example, banking is a bad business to be in. But for example, very good management, maybe in the case of HDFC Bank, in the which is Aditya Puri. So very good management and bad business, it makes good business. Because HDFC Bank stock, you will see, like 30-40 years, it has been a phenomenal compounder. So you have to see the management quality, and management quality is a little subjective thing because you have to see if the management company is not sure. Because in India, around more than 50% of companies which are listed in the Indian stock market, they manipulate their accounts and balance sheets. So this is an example of chore management. So you have to identify crooks because they will scam you. For example, if you see, there was a very famous company, you might not remember, Vakrangi, and everyone used to talk about it earlier. Then the company just faded out. There was one more company, DHF. There was Yes Bank. Yes Bank was said that Yes Bank is the new HDFC Bank because HDFC Bank is treated as 24-carat Bank of India. So now Yes Bank is nowhere. Like, such kind of things, these have to look out for the management. This is also the major component of doing fundamental analysis. So we start with this, the market cap. In 2023, it is around $12 billion. and you will study the company structure, what it is there. So these are the, then there are these analyst expectations that this is the forecasted growth rates. For example, analysts are assuming that the earnings means profit growth. Profits will increase of Cipla by 17%, the industry by 19%, market is of 18%. That means that this is a slow moving company. This has less growth because the growth percent is less than the market. So this is a negative thing. Then you will see forecasted revenue growth. Revenue means sales growth. So difference between sales is the total money you get from doing all your sales, or your selling your stuff. Then after all the expenses is the profit. So even though the profit growth is 17%, the sales growth is just 10%, which is again less than the market. That means that this is a bad thing. The second thing, which is a little complicated to study, is financial statements, and this is called financial statement analysis. It involves three parts: studying the P&Ls, the profit and loss. The second thing is the balance sheet. The third thing is cash flow statements. So actually, accounting works a little differently, and we are not discussing here accounting, so we will get back to it a little short after. But there is a difference between all these things. Even though they sound very similar, balance sheet, profit and loss, cash flows, but there is a difference. So cash flow tells about the cash position of the company. For example, your friend is liable to pay you 1,000 rupees, but he hasn't paid to you, so the cash is not there in your pocket, so you cannot spend that money. For example, you go to buy something, that shopkeeper will ask you cash. So even though you are revenue rich in theory, but you are not cash rich. So this is the difference between cash and revenue. The reverse situation can be true. For example, you have taken some debt from somebody, so you have cash in your pocket. So even though you are revenue not rich, poor, but you are cash rich. So बिजनेस में बोला जाता है कि जिस बिजनेस के पास कैश नहीं होता कैश तो बिजनेस मर जाता है. कैश इज द भगवान ऑफ बिजनेस. तो इसीलिए कैश फ्लो स्टेटमेंट एनालिसिस करी जाती है कि इवन दो कंपनी बोल रही है कि इतना रेवेन्यू है, इतना सेल्स है, इतना प्रॉफिट है, बट व्हाट इज द एग्जैक्ट कैश फ्लो ऑफ द कंपनी. द सेकेंड थिंग इज P&L. So P&L refers to basically just a profit and loss usually for a single year, and balance sheet is like the current state of the company. So for example, till now at this point of time, for example, in today is what, 22, what is the date today? 19 October 2024. So balance sheet will tell us about what are the company assets, what are the liabilities, what is the equity at a given point of time. For example, 19 October 2024, it will tell what is this P&L just tells about the profit and loss. So for example, it will cover about the whole year, or the whole quarter, whatever you are studying, about what are the revenue, then what are the cost, expenses incurred, and then finally profit or loss, which is revenue.
This being a very cash to positive, always a positive signal, because I've heard that, like for example, Apple has a lot of cash stored in it, and it is seen as a dying sign because they don't have enough innovative ideas to invest in it.
This is a different thing. Basically, this is that the growth is less, but cash is more. Yeah. This is a good thing, but not the excellent thing. What you are looking is a business which is having cash and which is having growth. I will tell you an example. Look at the business of Amazon. What it does. Amazon business has very less margins. They just make not more than 5% profit margin on the product that they sell. But why they are doing that business? The reason is, when you order from Amazon, you pay just now. The product will arrive a week later. Amazon will pay the supplier maybe 2 months after. So for 2 months, they have cash with them, which they have to pay to suppliers. So it's a cash-rich business. Basically, we say in business language as what do you say? That take more sell on credit. Buy on credit, sell on cash. This is a business where Amazon is buying on credit. Amazon here is buying on credit, selling on cash. So this is an excellent business. Even though margins are 4-5%, despite that, it's a great business. So what will Amazon do? It is having surplus cash with it. It will invest that money in newer businesses which are having more growth, which are having much greater profit margin. So what in the Amazon case, what they did, they invested this money in Amazon Web Services. So Amazon Web Services will have a margin of more than 70%. Even though the grocery segment is making 5%, they invest that money there. There they get more growth. There they also get more margins, more profit they make. They are not making profit through you. They are making through Amazon Web Services. But the grocery business is giving them cash, is giving them volumes. Any other doubt? So let's see financial statement for FY 23-24 means from 1 April 2023 to 31 March 2024. So in financial statement analysis, the first part is that I told you, which we are not going in more detail because it's like a whole course on accounting. But the portion that we can easily study is financial ratios. So for example, I give you two businesses. The first business is you invest 100 rupees. After 1 year goes by, it makes profit of 10 rupees. The second business makes a profit of 100 rupees. But you have to invest 2000 rupees. So which is a better business? If you see on surface, you will say that the business making 100 rupees profit is better. But actually, that business is making 100 rupees profit on 2000 rupees sales. So if you do a ratio, you will see, okay, so this is 5% of my return on investment. But in that case, it was 10%. So the business A is a better business. So you kind of did a sort of a basic rough ratio analysis. So in business, ratios are very important, and we will not see all the ratios, but we will see few of the ratios. Also, ratios are very important to value companies. So is the company is overvalued? Is the company undervalued? How we will figure out? By looking at the valuation. We will not see that, okay, this share is 10,000 rupees, this share is 5 rupees, so 10,000 rupees is overvalued, 5 rupees is undervalued. This is not how it functions. A 5 rupees share can be overvalued and a 10,000 rupees share can be undervalued. This is done through ratio analysis. So there are different kind of ratios. Qualitative ratios also, quantitative ratio also. We will focus more on quantitative ratios. The ratio can access company's liquidity. Liquidity means, like for example, if the company is sold today, what will the condition be? Can it repay its debt which has taken today? Leverage, which tells again about the debt of the company. Growth, margins, profitability ratio, return ratios, valuation ratios. So they tell different things. Let's say some basic examples for Cipla. This is the snippets from Screener. If you want, you can use it also as of now. So these are the financial ratios. So the P means the P ratio is price divided by net profit or earnings. So basically what you do, you take, this is basically the EPS, earning per share. So what you do, you take the share price. For example, the share price, okay, this is not visible here. The share price is 100 rupees. And the net profit of the company, maybe it is 1 crore rupees. And the number of shares of the company in the market are, let's say, also 1 crore. So the earning per share will be 1 crore divided by 1 crore, which is rupees 1. So EPS is 1, price is 100. So P will be 100 divided by 1, which is 100. This is how you calculate P ratio. So this basically tells the valuation of a company. If the P ratio is high, generally it just thinks that the valuation is more. If the P ratio is less, then the company is undervalued. But there are a lot of complexities hidden. A simple P ratio does not give much information actually. You have to see other ratios as well. So the second thing you are seeing in screen here is ROC. ROC basically means ROE and ROC are kind of related. Return on equity and return on capital. So return on equity basically is net profit by equity, book value. these two ratios tell us the quality of the business. The earlier example that I told you, that a business which is making 10 rupees profit from 100 rupees investment, and other businesses there which is making 100 rupees profit from 2000 rupees investment, you are kind of doing a ROI analysis. You are saying, okay, profit divided by investment. These ratios are similar to what we did. In equity, what you do, you take the net profit, you divide it by the book value. Book value is basically the equity value. So how you calculate the book value? You just do assets minus liabilities of the company. So for example, the assets of this company may be 1000 crores and the liabilities are 500 crores. So the book value will be 500 crores. So how you will return on equity? Let's say the profit is, let's say 50 crores. So you will divide 50 divided by this 500. So the return on equity will be 20%. Sorry, 10%. This is how return on equity is calculated actually. And EBITDA is basically an earnings before income and taxes. It's similar to profit only, but it is greater than profit. And capital employed is the capital that we employed. So it is similar to that analysis that we did, that we invested this much money. So this ratio, return on capital employed, or ROCE or you say, that is similar to the first analysis that we did. So is this portion clear? What is return on equity, return on capital? Both these ratios tell the efficiency of the business, the quality of the business. The higher the return on capital employed and the return on equity, the better is the business. Okay, so actually it depends upon your industry. For example, it totally depends if you are a asset light business or an asset heavy business. For example, let's take an example of mining business. It is an asset heavy business. Take an example of steel business. It's again an asset heavy business. Take example of banking business. It's a asset heavy, or maybe it requires more resources to do that business. Take example of IT business. It's a asset light business, because what is the asset? Nothing. You have offices, chairs, that is also rented actually. Employees, what is the asset? There is no capital employed in the business. So those will automatically have high return on capital and return on equity. When you compare these ratios, do them in the context of the industries that they operate in. For example, HDFC Bank have a return on equity of 15%. And some Chinnu Munnu IT company will have a return on equity of 50%. Does not mean that our HDFC Bank is a worse business than that Chinnu Munnu IT company. It can be the other way around. So when you compare ratios, make sure you compare it to the peers in the same industry. If you are doing cross industry, then never compare the return on capital employed. Always compare the return on equity. Return on equity you can still compare, although it's not preferential, but still you can compare, but never do with the return on capital employed. So for example here, the ROC is 22%, it's a good thing. Any value greater than 15%, it's a healthy thing. Return on equity, again more than 50%, 15%, 16.8%. Stock PE is 28.3. This is price to book. So price to book, basically the price of the share divided by the book value of the share. How do you find book value? You just take the book value of the business, you divide it by the number of shares to find the book value. This is again a ratio, EV by EBITDA, basically enterprise value by EBITDA. Don't go into complexities, but this is also similar to PE ratio only, but a little different. The formula is a little different. Debt to equity, very important ratio. That the total debt the company has compared to its equity. For example, a company has 100 rupees equity, it has 2 rupees of debt. In this case, then that means the debt of equity is 0.02. So debt divided by equity. Cash by market cap. So how much cash it has, free cash it has, divided by market cap. So if the market cap is 100, the cash which supplies is rupees 1 in this case, because it is cash by market cap is 0.01. So the greater the cash by market cap, the better it is. This is operating profit margin, OPM. This is the average 5-year operating profit margin. So there is different types of margins. First are gross margins. first are gross margins. Then gross margins is just, for example, you are selling samosas. So you sell a samosa for, let's say, you sell a samosa for 20 rupees. The cost of raw ingredients is, let's say, 5 rupees. So your gross margin will be 15 rupees. 20 minus 5. Gross margin percentage, gross margin in percentage will be 15 divided by 20, 75%. Then you see that after 5 rupees expense, this is just a raw material. Then 5 rupees is your rent and electricity cost. Then you will come to 10 rupees. Then you pay 2 rupees in interest also. Then there is 3 rupees of manpower cost. Finally, you get to the net profit. So in between gross profit and net profit, there is something called as operating profit. Operating profit means kamkaji munafa. It is all the profit which is before income and taxes. So operating profit can be broadly equated with the EBITDA. EBITDA is earnings before income, taxes and amortization. The profit before subtracting taxes, before subtracting depreciation, and before subtracting amortization and interest. Interest, for example, you are taking a loan, so you have to obviously pay interest for it. So that margin is 21%. This is market cap to sales. So the market cap of the business divided by the sales itself. For example, it does sales of 100 crores and the market cap is 479 crores for Cipla. It's an example, it's not. Then there are what EPS is there. Sales growth, very important. The more the sales growth, the better is the business. Then there is profit variation, also profit growth. Then sales growth average for 3 years. EPS growth, earning per share growth of 3 years. So all the growth parameters, the higher they are, the better they are. Then finally, this is there, the PEG ratio. This ratio was introduced by Peter Lynch. PEG ratio is just you. For example, in PEG ratio in P ratio, the limitation is there. It does not discount for growth. For example, there are 2 businesses. One business is Zomato, which has, these are real values, 400 P. The other business is Reliance Industries, 30 P. So you will, on seeing P, you will compute that, okay, Zomato is a very overvalued business and Reliance Industries is a very undervalued business. The analysis is wrong. Why? Because Zomato is growing 50% year on year and there is no growth in Reliance. So to account for growth, you divide this P number by the growth it is doing. The growth is in the form of your earnings growth, EPS growth. So you divide this by EPS growth, this number, whatever it comes. For example, in this case, let's say EPS growth is 20%. So you divide 100 by 20%, which number is 5. So this is the PEG ratio. So PEG ratio also tells the value of the business. So according to Peter Lynch, never buy a business which has more PEG than 1.5. Theoretically. These were the financial ratios, actually the slide was meant. There are more ratios like that. Like for example, current ratio. Current ratio basically take care of current assets divided by current liabilities. So current asset means current, this year's. So for example, which are the immediate assets and the immediate liability. For example, the immediate asset is, for example, a customer has to pay you 1 crore rupees after 3 months. That's a current asset. The current liability can be, you have to pay salaries next month to your employees, maybe worth 20 lakh rupees. So when you do this analysis, when you divide the current asset divided by the current liability, you get the current ratio. So the more this ratio, the better it is. So you have to look for a business which has higher current ratio. Debt to equity we have discussed. Also one more ratio called as quick ratio. In quick ratio, what you do, inventory is divided by the current liabilities. So for example, you are running a gold business. Let's say you are running a franchise of Titan. Your inventory is obviously your gold ornaments, which is in the form of gold, which is like liquid cash. So inventory, maybe you have 1,000 crore rupees of ornaments with you, 1,000 crore rupees inventory. And your liability is, let's say you have to pay to some bank, a liability maybe it's 200 crore. So quick ratio is going to be 1,000 crore divided by 200 crore, which is 5. So this quick ratio, the more it is, the better it is. Then we discuss about it, earning per share. This is also a ratio that you do take net profit or net earnings divided by total number of outstanding share in the market. Then P ratio we discussed about, return on, similar to return on equity and return on capital. If we take in the return of equity case, the numerator remains the same, net profit divided by assets. If you divide it by assets, it becomes ROE. And we will subsequently now see what is the relation between ROA and ROE and how it works. Very important, dividend yield. So dividend yield is, for example, you hold a share, 100 rupees share, and you get, in a year, get 1 rupee dividend. So the dividend yield will be rupees 1 divided by rupees 100. So in this case, multiply by 100 to convert it into percentage. The dividend yield will be 1%. So if you see, for in the case of Cipla, what was the dividend yield? Dividend yield was 0.84%. That means that if 100 rupees is the price of the share, you will receive in a year dividend worth 84 paisa. Okay, so this is the quick, some important ratios. The ratios are many more, but we are discussing only important ones. Then you will do peer comparison with other players of Cipla. So what are the other competitors in India? In India you will do. So other competitors are Sun Pharma, we have Dr. Reddy's, Mankind Pharma, Zydus Life Sciences, Lupin, Aurobindo Pharma. These are all the its peers, competition. So you will see, okay, what is the lowest multiple having company. So Cipla is having 28, it is less than the competition, which is the median is 36. Aurobindo is all having 24. You will conclude the most undervalued company is Aurobindo. Then you analyze dividend yield. The dividend yield is highest in the case of Cipla. So in first two parameters, Cipla is better than this competition. Then you do net profit. But net profit is, you cannot compare net profit because, for example, some company will be worth 100 crores, some company will be worth 1000 crores. So comparing the net profit of 100 crores with a company of 1000 crores does not make sense. So the better will be net profit by your market cap, or doing ROE, which is net profit by equity. So hence there is the importance of ratio analysis. Then you will do net profit. This is the net profit growth or variation. So for example, for Sun Pharma it is 25%, for Cipla it is 18%, Dr. Reddy it is negative 0.9, Mankind 27, Zydus 29, Lupin 77, Aurobindo Pharma 50. So here you see that even though in the first two parameters, price to earning and dividend yield, even Cipla was looking a good stock, but actually when you come to the growth section, you analyze that the highest growing stock is Lupin. So maybe Lupin is the best stock. So for that you have to again compute what? The PEG ratio to compare. PEG ratio is the P divided by growth. So you will take this number P, you will divide it by this to compute the PEG ratio. So the lower PEG ratio, the better it is. Then this is sales quarter variation or sales growth. So for example, the highest growing business is here, Zydus Life Sciences. But in terms of earnings or profit, the highest growing was Lupin. Then there is return on capital employed. So the highest return on capital employed here it is of Dr. Reddy's. And the median is 15. Then return on equity. The return on equity also the highest is of what? 19, 21. Dr. Reddy's again. So you are seeing that if you see valuation wise, Cipla and Aurobindo Pharma is good, valuation wise, dividend wise. If you see growth wise, then Lupin and Zydus Life Sciences is good. Then if you see maybe your efficiency wise, because return on equity and return on capital tells the quality of business, the efficiency of a business. Then the best business is Dr. Reddy's lab. Okay. And also second business, which is Mankind Pharma. So in different aspects, you can see in different aspects, different businesses is good. Now you will see debt to equity. Debt to equity, you will see the highest debt to equity is of Aurobindo Pharma, and the lowest debt to equity is of Mankind Pharma. So Mankind Pharma is the best if you see debt to equity, because there is no debt, zero. So if you figure out, I like the most businesses Mankind Pharma, because it's, even though it's little higher valuation, but it has decent growth. It is a good quality business, because good quality is judged by return on capital and return on equity, and it has very less, no debt. zero debt to equity. So this is how you, maybe in some section this is good, in some section Lupin is good, for something Zydus Life is good, for something Sun Pharma, Dr. Reddy's is good. But eventually you found out which is the best business, which is the sum better of all those. So if you want to learn fundamental analysis, these are some good books. One Upon Wall Street by Peter Lynch, Common Stocks and Uncommon Profits, very good book. 5 Rules for Successful Stock Investing, 100 Beggars. We discussed about this book the last session and final discussion. And the best of them is Thoughtful Investor by Basant Maheshwari. So you can refer if you want to. So if you want, let's say the main analysis that you want to do is, you want to find through fundamental analysis a business that will increase its stock price maybe 5 times, 10 times in some years. This is the main goal that you are with. So if that is the goal, you will do your fundamental analysis that thing. And because in fundamental analysis there is a lot of things to consider, we will pay some more focus on few things which matter the most. So what does matter the most? The first thing is the valuation, because even if you buy diamond for a price of gold, it is good. But if you buy copper for price of gold, it is bad. So copper is also good, diamond is also good, but it is depend on the price that you have bought. So that's why valuation analysis is very important, and valuation is a whole different topic and it has a different course altogether. But through basic ratios like P ratio, PEG ratio, market cap to sales, EV to EBITDA, these basic ratios can give you the basic understanding that which businesses are overvalued, which businesses are undervalued. So the basic maths, if it is there. Is this, that we have P ratio, price divided by earnings. If we multiply earnings, you get what? P again. What do you want? You want the price to change. So that means that you want delta P to be more. So what will be delta P? Delta P will be delta P plus delta E. Okay, so you want more price to increase more, that means that you want delta P to be more. Hence either delta P should increase or delta E should be more. So delta E basically earnings growth. So the business should have good earnings growth. And second, either the earnings growth should be more or there should be P increase. And we call it as P expansion. So all the stocks which have become multi-baggers, they have these characteristics that they will start with a low P, eventually get to high P. This is called P expansion, when the P expands itself. And they will have very good earnings growth. These all are growth stocks. The third thing will be the return on equity. These businesses mostly will be high quality businesses. And high quality is defined by the return on equity or return on capital employed. The better number is return on equity, so we stick with it. And the fourth thing can be, they can be turnaround business. For example, the business is doing bad now, but in future it might do well. This is an example of turnaround. For example, the best example of turnaround was Tesla. So Tesla was used to make losses till 2018. Till 2020, 2021, the business was in losses, but during this time, 2018 to 2021, the business has operating profit. Operating profit means kamkaji munafa. That after paying all the expenses of operating expenses of the business, you are left with some profit. You are not in losses. Even though the company is in losses, because you have to pay employees, you have to pay interest, you have to pay taxes, you have to pay depreciation. So the company was in losses, but it was on the operating level, it was profitable. So during this time, 2018, 2021, the bull run for Tesla started because the stock was a turnaround. So from loss, it became profitable. In 2021 approx, it became profitable. So for example, Tesla, it was a wealth creator. It had turnaround. Second thing, it had P expansion. Third thing, it was always a very high earnings growth company because the growth was very high, because they were targeting an industry which is electric vehicles, which is a very fast growing industry. These are the characteristics of good businesses. So this is our, from Indian context, 1994 to 2040, 20 years. This this is how much wealth these businesses have created, and these businesses are the highest wealth creators of India. So the highest may be what? Infosys stock became 2900 times in this 20 years. Lupin, Wipro, Motherson Sumi, it makes auto components, Shree Cement, Kotak Mahindra Bank, Imami, which is FMCG company, Vakrangi, which I was talking about, which was eventually a Stani company, Eicher Motors, Aurobindo Pharma Company, Blue Dart Express, Havells, Amaraja Batteries, Sun Pharma, PI Industries, Balakrishna Industries, Glenmark Pharma. Okay, that was a company that I was referring, that did some R&D research and figured out a new drug, and through that, because of that, it became eventually a 300x from 2000. 2000 year it had a cycle, 14 years becomes 300x. Hindustan Zinc, mining company, KPIT Tech, it's developed these software for EVs. Symphony, coolers of Prestige, I think pressure cookers, Titan watches and jewelry, Cipla is medicines, Hero Motocorp is auto. Glue Finance. Glue Finance was a subsidiary, earlier used to be subsidiary of HDFC Bank. It was the housing finance part of HDFC Bank. Then it merged with Bandhan Bank in 2018, but it was a great wealth creator, 200 times in approx almost 10 years. So there will be common characteristic on all these companies. Most of these companies will have a high return on equity. They will have high earnings growth, and they will start with a low P ratio, eventually get to high P ratio. That means that P expansion is there. So three important things: earnings growth, P expansion, and high return on equity. This is a common characteristic of all these stocks you mentioned. From Axis Bank to Kotak Bank to Shree Cement to Imami to Havells to Amara Direct. So the same thing I was telling, that if you want, the market cap should be initially small, because if the small market cap is there, the chances of growth is higher. That's why the returns of small cap, mid caps is more than the large cap companies, because you start with a small market cap. You start with a low multiples, low P ratio, and you have high growth, and very important thing, which is margin expansion. For example, you are working in a business and you transform your business to a better business. Better business in the sense it has better margins. For example, Reliance. Maybe Reliance is now working in petrochemicals, and after some time, Reliance become a technology company. So technology company have more margins as compared to your oil companies. So in this case, what will Reliance do? Its margin will expand. So margin expansion is very important thing that we will look at fundamental analysis. The very important thing is management should be good, and the promoter or the owner of the business, it should have enough stake. For example, if the stake is 5-10%, there is less skin on the game. Skin in the game means उसकी कुछ जिम्मेदारी, accountability, उसको भी कुछ फर्क पड़ता है, business को कुछ होता है. अगर for example it has 50% stake, so for example the share price crashed by 25%, his wealth is also gone down by 25%, so he cares about it. If it's very less shares he has, he will care less. Then the thing is capital allocation. Capital allocation means the business should have higher efficiency, and efficiency and quality of business is judged by ROE. So a management or a business that is able to get good return on equity, good return on capital, it's a good business. That shows that it is a good capital allocator. And I will tell you a very good example of capital allocation in the case of ITC. So ITC has a very good business. It's king business. It cash cow, which is your cigarette business. So cigarette business is very good because it is not impacted by recession. People smoke, and also the margins are very good. For example, a 10 rupee cigarette, there is a manufacturing cost of 2 rupees, 3 rupees. So it's an already settled business. There is very low scope for competition, because a person who is used to smoking a particular cigarette, he will smoke that. For example, there's some cigarette which give out smoke very more. So for example, you like a very smoky cigarette which releases more smoke, so you will not change your preference automatically. So the competition aspect is very less. But there is one problem in this business, that this is not a growing business, this is a dying business. Every year more and more people will not come and smoke, because smoking is not cool anymore. It used to be cool when movies of Bollywood used to depict cool people smoking, but now the cool thing is to drink, not to smoke. So people, due to health reasons and all, they are less smoking, although they don't care about health because they are drinking anyways. But you have to judge, is it a growing business, is it a dying business? So the problem there was that even though business is very good, it's a very high return on equity, return on capital, every aspect of the business is fine. Only one thing, there is no earnings growth. So how you will get earnings growth? If you are a manager, what you will do? You will eventually what you will decide, okay, let me enter new markets. So that is what exactly ITC did. ITC now ventured into FMCG business. So Ashley you have, and Sunfeast Biscuit and Bingo, lot of brands they have built in FMCG category. Classmates. So very good example is Classmates. So why they figured out that we should sell notebooks, and that too very high quality notebook, because they thought that if student is introduced to ITC products from a very beginning, so when he turns teenage, 15-16 years, most probably he will smoke ITC cigarettes. So this is how brand plays with you. They want that you should be part of your brand from the day you are born. The same thing is done by Nestle. They ventured into this Cerelac business, Cerelac, and they make baby powder and baby milk. So why they ventured into these businesses was not they did these analysis and find out that this is a good business. The reason was that if a child when he's 1 year old, he's eating Cerelac, he's used to eating Cerelac, he's introduced to Nestle in such a tender age. So maybe he grows up. So when he's eating chocolates, maybe he will prefer Nestle chocolate. Now maybe he's 15 years old. Maybe he will drink coffee of Nestle. So maybe he's 18 years old in hostel. So he will not eat Yippee, he will eat Maggi because it's of Nestle. So this is how brands play with you. And these analyses are also very important. When you do fundamental analysis, it's not just you look at numbers. You also do quantitative analysis. You study about the business, what the business is all about. So the thing I was talking about ITC, those ITC ventured into more businesses. One was paper business, one was FMCG business, one was hotels business. So ITC runs the most amount of hotels in India. There's a huge range of hotels. And also they ventured into a real estate business, construction business, a lot of businesses they ventured. But eventually what they did, every of these business has a very inferior return on equity and return on capital compared to their flagship cash cow business, which is their cigarette business. So these businesses are not giving them any money. They're just giving them some sales growth. So this is the example of a wrong capital allocation where the management, for the sake of increasing its revenue, has ventured into bad businesses which has destroyed wealth for its shareholders. So this is the example of capital allocation. So in fundamental analysis, the very important thing is how you judge management is not through what education the management brings, but you judge him by what decisions that he takes. For example, capital allocation decision. For example, this was a bad decision to begin with. Very important thing is pricing power. So in fundamental analysis, one more important thing that you do is you look at the pricing power. All the good businesses have pricing power. Pricing power means that, for example, a competitor is selling a thing for 100 rupees. If you can charge 200 rupees for the same exact product, that means that you have pricing power. Very good example, Apple products. The same specification mobile phone of Samsung might be available for 40,000, but Apple might be able to sell it for 1 lakh rupees just through Apple. This is a very good example of pricing power. Another example could be Nike shoes. The same shoe can be sold by Bata for 1,000 rupees. Nike will sell it for 10,000 rupees, saying that it's a Air Jordan and stuff like that. This is an example of pricing power. So all these good businesses, they always have pricing power. Then they have high return on capital and return on equity. Then the industry should be either a stable industry or it should be a growing industry. It shouldn't be a dying industry. So what is the example of a dying industry? Let's take example of newspapers. So newspapers are a dying industry. People are no longer reading newspapers. So with time, these companies will fickle away. Another example are TV businesses, TV media businesses. For example, NDTV News, for example, ABP News. People are more and more shifting their preferences towards internet compared to TV. People are no longer watching TV. So you want a growing industry. For example, what can be growing industry? Artificial intelligence, Internet of Things, blockchain. It can be electric vehicles, clean energy, green hydrogen, solar, etc., etc. These are all growing industry. But if you are, for example, in oil industry, it's a dying industry. That's why Saudi Arabia or UAE, they are all shifting their although their current main revenues, GDP comes mainly from oil, from selling oil, refining and selling crude oil. But now they are shifting more towards tourism because they figured out that this is a dying industry. Eventually, EVs and clean energy sources will eventually replace us in maybe 100 years. They are preparing for now. So whenever you analyze the fundamental analysis, the very important thing is industry analysis. Is the industry stable or growing, or it is declining? If it is declining, then it is worse. So these are very good examples of good businesses. Berkshire Hathaway, Aarti Industries, make amines, Monster beverages. I think you must have seen this. Energy drinks, Monster. Okay. PI Industries make fertilizer, Kotak Bank, Amazon, Deepak Nitrite, make fertilizers, chemicals, Catland, software, HDFC Bank, Shopify, Avanti Feeds, so it makes feeds for fishes. Divi's Lab make these APIs, Amara batteries, Balaji Amines make aliphatic amines, Shree Cement, Eicher Motors, this make Royal Enfield bullet. Bajaj Finance, Alkyl Amines, APL. APL Apollo basically makes steel tubes used. So this is a quote by Charlie Munger. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it. If the business earns 6% on capital over 40 years and you hold it for 40 years, you are going to make not more than different than 6%, even if you originally buy it at a huge discount. Conversely, if business earns 18% return on capital over 20-30 years, if you pay an expensive price, you will end up with a fine return. So whatever he is saying is, even though valuation is very important, you need to buy a business at a cheap price. Eventually, it is the quality of business that Mr. Munger and Warren Buffett focuses on, because they are saying in the long run, for example, if you hold a stock for 40 years, your return will be dependent on the return on equity and return on capital. For example, the ROE is 20%, more or less you will make 20% returns. If the ROE is 5%, more or less you will make 5% return. It does not matter your starting valuation. So even though you bought the stock very expensive or very cheap, you might end up the results which is reflected from their return on equity. So that's why whole focus should be on 2-3 things: return on equity, P ratio, earnings growth. These three things are the most important thing in investing. So capital allocation is how companies employ their money. Will they employ money in new growing business segment or business segment that will destroy them? For example, the case of ITC, although they deployed money in new business segments, but those business segments were not growing business segments, they were dying industries. Deleveraging basically means that the company reducing its debt. Very good example is Adani, all the companies of Adani, including Adani Enterprises. So there was a Hindenburg report in 2023 that was launched, that was there. After that, all these Adani companies deleveraged themselves, paid most of their debt. This is the example of deleveraging, the company reducing its debt. If deleveraging is there, this is a very good example which businesses you should look at. Then CAPEX. CAPEX means capital expenditure, making new factories, investing money in capital assets, in productive assets. Advertisement drives research and development. Why advertisement is good? Because it will drive more sales. Why research and development is good? Because you will make better products that will eventually increase your sales and profit in the future. Acquisition. For example, you are like very weak business. For example, in the case of ITC, the better decision could be not venturing into a new business segment, but to acquire companies, existing good companies with the cash flow that they have. So if you feel like that by acquiring you can increase your revenue without impacting your return on equity, you should go for acquisition. Buyback. So basically, many companies do share buyback. Apple is a very good example. Basically what they do, they buy their own shares from the market. What does this do? That firstly it increases the okay. So firstly what it does, it decreases the supply of stocks, your shares in the market, and increase the demand for it, for eventually the prices increases. In the case of buybacks. So buybacks is also a very good example how wealth gets created. Dividend. If you give more and more dividend, to get dividend, people usually go to buy the stock, and if they buy the stock, then supply demand come into favor. That the demand is more, supply is limited, then the stock price increases. So all these decisions, if the management of the business is making these decisions, it's a good signal. So we will take some case studies. First is Navin Fluorine. Navin Fluorine makes fluorochemicals. So earlier this business used to make refrigerant for the refrigerator, but eventually they realized that this is a dying market. So they shifted and ventured. They still make refrigerants, but now they are also making inorganic fluorides. So this business was started again in 1967. Fluorides. So these fluorides are used in industries. Then they also make specialty chemicals. They ventured into this business around 33 years later because they realized that these two businesses are dying businesses. And recently in 2011 they ventured into CRAMS. CRAMS I will tell it about. That CRAMS is basically that big companies, what they are doing. For example, they do R&D because in India R&D is not that good. They do R&D, for example, a US company is there and they make a particular molecule or chemical. Then they give contracts to Indian companies like Navin Fluorine to manufacture that chemical for them. So this is the CRAMS. This is the business of CRAMS. Contract research and manufacturing services. So these companies like Navin Fluorine also engages in some research and development, also engages in manufacturing of these chemicals on behalf of other multinational companies on a contract basis. So this is a very good business because why it's a good business? Because it's kind of a business like it's like a royalty on somebody else's code. Somebody else is doing the hard work, and after doing that whole research and innovation, they come up with a product, and now you have to just make the product. So your growth is not dependent on your decision, but their decisions. So it's like getting royalty on somebody else. So what eventually you are seeing, it's a good company. Why it's a good company? It is continuously getting into segments which are better than the previous segments. Better means more efficient business, more return on equity, more return on capital. So this is how business metamorphosis. For example, larva converts to a full-fledged butterfly. Similarly, bad businesses shape themselves to high businesses. So bad business was refrigerant business converted eventually into a CRAMS business in the case of Navin Fluorine. Again, one more example is APL Apollo. So APL Apollo makes steel tubes. This is the capacity. Their manufacturing capacity from 2007 to 2020. So it was 0.8 million metric tons to 25 million metric tons. So you are seeing the growth rate. Amazing. So in this business, capacity is the most important thing because the demand is there. If you do capex, more and more capital expenditure, you spend more and more money into making factories, in improving your capacity, that will eventually in long run help you. So these are some decisions. PE rating of a business, high return on capital. PE rating means the P increases. Then the second mental model. Mental models means frameworks for thinking about fundamental analysis is variant perception. Variant perception means a different perception. So for example, the market is thinking in a certain way, you have a different perception than the market. That is variant perception. So these are all examples of variant perception. One is operating leverage, very heavy thing. I will not discuss it now, maybe later. Demerger. So for example, businesses demerging into why it is better because it increases the focus. For example, Reliance is there, it has all the businesses. It has oil business, it has Jio in it, and it has the retail business in it. For example, hypothetically, all these three businesses demerges. The share of Reliance is going to skyrocket because now shareholders will realize that they will have much more focus in individual businesses. So demerger is a variant perception. So if you are sure about if a company is going to get a demerger, the stock is going to rocket. If you have the perception and the market does not have the perception. Management change. So for sometimes what happens, very good management comes and then they transform the whole business. Sometimes very bad management comes and they destroy the whole business. Industry cycles. So every business has cycles, and if you are in the right industry having the right cycle, you are going to do good cost reduction. For example, if you are selling some commodity product, you are selling steel, and if you somehow due to some process engineering you are able to reduce cost of your steel, then your profits will increase. If you are sure about this, this is a variant perception maybe the market doesn't have. Margin expansion, we talked about it earlier. Corporate actions, like demerger is a corporate action. Buyback is a corporate action that we talked about earlier. Deleveraging means decreasing the debt. Product mix changes, CapEx. So product mix change, very good example was Naveen Fluorines. That earlier it used to be a refrigerant business, but now they transformed, bought new business segments through new business segments. They got new products in the form of CRAMS, contract research and manufacturing services. Capex, the more factories and more capacity they are building, as seen in the example of APL Apollo tubes. And that statement, high return on incremental capital, just means high return on equity and return on capital employed. So this is the three legs of a business. First is how great are the ratios, return on equity, return on capital, these things. Second tool is the leg is great management. Third leg is long runway to reinvest their profits. So whatever profits if they are making, they are reinvesting back into the business. Maybe installing more capacity, doing capex, these sort of things. Then, or maybe spending in R&D, maybe spending in advertisement. These all things make up a good business. One more example, very interesting example is Avanti Feeds. So this company Avanti Feeds makes basically fish feeds. So these are insects. This company breeds these insects that are used as fodder for fishes. So this is their sales in crores. So sales growth is a very important, and you will see eventually in the charts also it was eventually a 300-400 bagger stock. So sales growth. Then again Monster beverage, example of US, return on assets 18%, return on equity 22%, operating profit margin excellent 37%, net profit margin 30%. Excellent example of ratios. And see the industry, it is beating the industry hands on. 17%, it's 4%, it is 22% return on equity, industry is just 10%. This is the example of great businesses, and Monster beverages or eventually I think more than a 400 bagger stock. So then if you look at quantitative factors, what led to this growth was actually the product, that there was good margins in this product, and the product, due to good advertisement, the product was acceptable, and that category, they created a new category of energy drinks in the US. So I think we are late, so we will not talk about this. This is again a example for Amines business. So Amines business is a very good business because in all the pharma and chemical businesses, aliphatic amines, so compounds having NH2 functional group amines, these compounds are used in pharma and chemical industries. So these two companies have the duopoly in India for making amines, and because amines import is very restricted due to heavy duties, kind of they have very less competition. And both of these businesses did good because competition is very less, and these are like essential products for other businesses which are there. So we were discussing about Avanti Feeds. So it basically do shrimp farming. The shrimp are these insects and all that they feed, and that these are used for given as food for fishes. There is one more business like Deepak Nitrite. It makes nitrates. So these nitrates, there is a value chain. First raw material is supplied, and intermediate is created in the chemical industry. Then manufacturing will take this intermediate and convert it into a final formulation. So this is a key starting material. Then there are intermediates. Then there is active substance. So the APIs will fall into this segment, active substance. And the formulation is final medicines that you have. So for example, you are using Mankind pharma medicines, that is, they do formulations. Businesses like API businesses, active pharmaceutical ingredients, they do this business. Then there are intermediate businesses. So basically what Deepak Nitrite does, they make these intermediates, chemical intermediates, they are used in a lot of industries. One more very good example of good products is Continental Coffee. Have anybody heard about this company? Very famous coffee, I think. You have tasted this coffee. So the product that you have consumed, it is not even 1% of their business. 99% of their business is this. I am going to explain. So in the coffee industry, there is a very big supply chain. Coffee plant is planted, then beans are extracted, is harvested, then they are processed, then it is dried, then there is milling, exporting, then finally roasting and finally brewing. Whole lot of processes. The most critical process which gives coffee its aroma, its flavor, is the processing of the beans. Continental coffee does exactly this. They have a monopoly in India over coffee processing. So because they are very critical, doing a very critical functioning, and without this processing, whatever coffee you are consuming, its aroma will not be there. Its flavor is all dependent on processing. That's why it's a great business, because it is doing a job which is a very important part of the supply chain. If there is some business that is very important in the supply chain, then it's a good business. So all good businesses are not fine through this process of using numbers, using ratios. But if you study about the business, like this is a very good example. It doesn't have very good return ratios. I think return on equity is also 15%, which is okay kind of. But if you see at the business, phenomenal business. So this is a quote by Warren Buffett that he is describing about Disney, that why Disney is a phenomenal business. And they bought a significant amount of Disney stock at a price of 30 cents per share. The decision may appear brilliant given that the stock now sells for $66, so kind of the stock has got 200x, 200 bagger. But actually in 1967 I sold out at 48 cents per share. So this is the example of entering the business at wrong time. So what he did, even though they bought a very good business, but they bought at a very high valuation. Eventually, if you see in this time period, they got frustrated in 5-6 years that the price is not increasing that much. They exited that business, and eventually this man had a lot of did a great mistake. That he even though he had studied the mathematics part of it, the quantitative part of it, but he does not understood how great business Disney is, and that's why he sold. So when you do fundamental analysis, there are two parts. First part is the ratio analysis, financial analysis, studying numbers, studying balance sheets, studying P&L statements. The second part is actually studying about the business. But many times the later is more important than the former. Even though some people are there who does not have a very good understanding of numbers, balance sheet and all these things, because they are difficult to study. You need to, for example, if you are a CA or some professional like that, you are an accountant, you can study them better. But for people like us, we may have some experience or knowledge of some industry, maybe we have knowledge of maybe chemical industry or pharma industry. We can study those stocks better because we have a competitive edge, because we can understand the business, and business understanding is much more important than numbers understanding, because business comes more comes upper than numbers. Numbers is a later thing, business is the most important. So this is the last part. Watch out the future opportunities in India. This is all the presentation that I have given here. Even though it's applicable to US, but I have taken it to Indian context. The first 2030 growing industry is CRAMS. So CRAMS in pharmaceutical and agrochemicals. So very good example again, Navin Fluorine, CRAMS industry. Chemical industry. So even its specialty chemicals or its advanced intermediates, chemical industry is going to do good. Why? Because there is a theory of China plus one. That chemical industry eventually of China will go to India, because China there are a lot of restrictions coming on. Environmental restrictions, and in India these environmental norms are not very strictly enforced, they are relaxed, and in chemical manufacturing a lot of harm is done to environment. So this is a very good advantage for India, that chemical industry will eventually come to India. Also there is labor laws are weak in India, so your labor cost is less. Building materials, so be it sanitary ware, be it paints, or be it cement eventually, because there is a lot of infrastructure to be built in India yet to be built. Building materials is a very good space. Platform and exchanges, because these are very great businesses. Very good example of platform is Zomato, Swiggy. These are platform businesses. IEX, IRCTC, all these are platform businesses. Exchanges, so MCX exchange, BSE is a stock exchange. So you must be, if you have seen that competition, BSE stock did wonders. CDSL, NSDL, all these are exchanges. Pharmaceuticals, because India is like the pharmacy capital of the world, and pharma sector will do good in India. Animal healthcare, We don't get to in a detail in this presentation, but there is a very good business if you want to study called HighCall in this space, animal healthcare. Insurance. India is currently has only 5% penetration of insurance in India. And eventually, if India wants to become a developed country, eventually it will have 60-70% penetration. So there's a very big headroom for growth in insurance in India. That's why insurance is a very good category. Then finally, banks, NBFCs, and financial companies. Why they are a very good future opportunity? Because today in India there is a lot of credit requirement. Businesses need credit, individuals need credit. There is a lot of credit culture being promoted. People are buying things on EMI, people are buying phones on EMI, and this EMI culture, this credit culture will accelerate in the future. And also, credit is not required only for consumers like us. It is also required again by businesses, MSMEs, small businesses, medium businesses, big businesses even. So all the good, but here is a very important thing, well run, because banking is a very bad business. Because in banking what you do, you get deposits from people at maybe 5% interest, you give out in loan in 7% interest. So you are just making that 2% in the middle. But in order to get that 2%, there is a very big risk involved. For example, somebody like Vijay Mallya comes, he goes to London and he does not pay your loan. So all your 100 rupees is gone. What will you make? So it's a very risky business. So well run is a very important thing. If there is chore management in your bank, it will like do very bad for you. Very good example was Punjab National Bank. Very good bank it used to be. Then all these incidents of Nirav Modi and all happened with Punjab National Bank, and bank has to see a lot of tough times. So the most important thing is well run. So NBFCs, there was an NBFC, very big NBFC, second largest NBFC of India, that was DHFL, Diwan Housing Finance Limited. If you can ask to your parents how big DHFL was. Now DHFL is zero. DHFL has to close everything in 2019. Declare itself bankrupt. So very important thing is well. So these are all the opportunities: CRAMS, chemical, building material, platforms, pharma, healthcare, insurance, and banks. This is the example. Financial services. India has low penetration, only 10% penetration compared with different countries like US, UK. There it is 80% penetration. Chemicals, if you see, the growth is very good. 2010, 2018, 3% market share to 5% market share globally of India in chemical sector. It is growing day by day, and it's a very good opportunity. So this is the conclusion of what all we discussed in fundamental analysis. Fundamental analysis is actually studying about the business. So what all things are there in the business, the industry. Look at the industry size. So we just talked about it, that what are the good industries. The business, even though it's in a good industry, should do good capital allocation. So that will be, capital allocation can be just through studying these numbers. Then you have to study supply demand. Then you have to study moats. Moats we didn't discuss, but moats, if you have seen the newsletter we have sent, in that we discussed about moat. Moat is basically the competitive advantage of a business. And again, source is what you get, that this is the competitive advantage. What is the source of the competitive advantage? Can the competitive advantage be challenged? Like, let's take the example. What is the moat of Apple? It's innovation and its design. But you are seeing that even though design is very good in Apple, but their innovation part is dying up. So maybe that can be a danger in the business. So this is the analysis of the competitive advantage. That is the competitive advantage going to sustain or not? Then this is the return on capital is increasing day by day. So the incremental return on capital, the current return on capital, if it is greater than historical return on capital, that means that return on capital is growing. So that's an example where how it can happen. It can happen through margin expansion. So this is the thing that you have to see. If this is happening, this is the example of a good business. So what we all discussed is how to identify good businesses. And this is all what fundamental analysis is, identifying good quality businesses. So thank you. So if you have any questions, you can ask.
I have a doubt.
Excellent.
How do I know if the management is good or bad? Like how can I find out?
So there are different things. First is you have to study the decisions that management took. So how you will study the decisions? You have to read subsequent year of their annual reports. In annual reports and conference calls, management tells that this is our business was, this is what we did, this is what is target is. For example, in 2015, some management said that we will by 2020 we will have maybe 500 crores in revenues. Now you can see that in 2022 they achieve what they said. This is example of how competent the management is. Second thing you cannot do it exactly right now is you have to study the balance sheets, P&L, the part that you left, financial statement analysis, which is accounting basically. Through that you can find out is the company chore company, is the promoter chore or not, is he the crook or he is the honest man. So if a promoter is honest, if a promoter is crook, if he is dishonest, no matter how competent he is, it's a bad management. Stay away from it. So there are various things. Third thing, you can do ratio analysis. Generally, good management have good return on equity, good return on capital, good less debt, so debt to equity will be lower. So we can do these ratio analysis and figure out. So it's not a simple thing; it's a complex thing, and it's not quantitative; it's qualitative. You have to maybe you can if you personally know the management, and it's very personal, not personally, but if you can get it that if somebody knows the management personally, you can get information through that. So there are various ways, no single way there. So any other question?